will actually use those little headings to think about what to think at each stage. Yeah. Okay, so our acceptance and continuance, independence, engagement letter, and staffing. Okay, our independence, see that we're actually independent from that company. We can actually take on the audit. Engagement letter, with an engagement letter sent out, our next job to do, I actually have a copy of an engagement letter that will actually be sent out to a company. And then staffing, deciding who in your staff is actually going to do the audit. And you have the audit senior, the manager, and the people underneath doing the groundwork, and who's going to be allocated to that. Okay, so that's the three things you'll be looking at when you're either accepting or continuing the audit. Our next step would be planning the audit. I'm going to go through a good bit of the ISAs for the planning tonight now. And I'll try to make it as interesting as we can. Hopefully it'll be alright. Okay, so the planning. Okay, we're going to be looking at our client risk profile. Okay, so our client risk profile. Knowledge of the business. Okay, so we look at the client risk profile and we look at the knowledge of the business to make sure that we have a good understanding of how the business works and what they're doing inside the business. Like if you're continuing, you've no problem doing the audit for years, but you've accepted it, there'll be a good lot of work to be doing this to get used to seeing what way they do what their business they're in and how they operate and everything. But that's what we're thinking of. Client risk profile, knowledge of the business. Once we've thought about that, we actually set out about doing our audit plan. Okay, so our next step is to make out our audit plan. This is all under our planning part now. So when we do our audit plan, what we're looking at here is we're assessing audit risk.
That's under the audit plan, is it?
That's under the audit plan now. But it's all underneath planning. Do you know what I mean? It's all in one line. Okay, and assessing our audit risk would be our audit risk, our inherent risk, our detection risk. And our control risk. There's 4 risks: audit, inherit, detection, and control. There should be choices, should there assess as this. Our next step then is to look at materiality. Okay, and our materiality is we're setting a materiality level that's acceptable to us.
That's all under planning, is it?
That's all under planning as well. Before you even go near the audit at all, you have to do all these little steps in a line.
What do you mean materiality level?
It's like, we do we to audit all the figures, right? But it's not possible to go through all the figures. So we're saying that there's...
How deep are you going down, is it?
It's like we'll accept that there's a 5% chance we might miss something inside the audit. And the figures are actually there, how much it'll actually take.
So do each company set like their own standard?
And there's kind of an overall one given the account that audit is supposed to follow. But like
it depends on the percentage of the turnover, isn't it?
Yeah. So like there's a 5%. I haven't got the figures off in my head now, but
but I just wasn't sure what the materiality was.
It's like saying, it's like a material.
Is it a material difference?
A material statement. It's like if it's material, if you look at the accounts and to make a difference to you when you look at the accounts, and it's not material if you look at the accounts and won't make any difference to you. Yeah? Yeah.
All coming back.
And our last one is audit strategy. Okay, our audit strategy. I should pull into all the little bits and pieces we've done for the last couple of weeks and see where we're actually going with them. So our strategy will be like done in-house to see how we're actually going to do it, and it'll be linked over to our staff, what staff are going to be doing, what part of the audit and stuff. Okay, so that's our continuing acceptance and our planning. So once we've all that done, we can actually start doing our audit. So our next heading will be execution of the audit. Okay, so under our execution, we've got a couple of different headings. So the first job we do is develop audit programs. Okay, so we develop audit programs and procedures. And we'll be going through that tonight about our audit programs and procedures, just looking to see what we'll be doing in it. We're going to test the controls. Okay, and these are our internal controls talking about now, the internal controls of the company. And the reason we're testing them is to see how we're going to determine their reliance. So we're going to test them to see can we actually rely on the controls the company has set up. And if we can't rely on the controls, we're going to have to do the next thing, which is substantive test. Okay, and substantive testing is like where we test a portion of the item. So say we're going to debtors, okay, and we're going to test 30 of the debtors' figures at the year end and see are they actually right and get confirmations about them. So this is a lot more work in our substantive testing.
Is that only done if the internal tests?
Yeah, if you can't rely on the internal controls, you have to do substantive testing. And in every audit, you have to do substantive testing. Yeah. And then our last one is to evaluate.
Is that because the controls are internal
Yeah.
and you wouldn't trust that
You wouldn't, yeah, that's it, yeah. Like if you start testing them and they're not working, do you know what I mean? It means you've more work to do inside here.
But if the controls are not working, you still do substantive
You said,
testing,
yeah. You wouldn't have to do as much, yeah. If you can rely on the controls, and they are very good controls and they are being keeping in place, you have less substantive testing to do. And then our last one is to evaluate, reassess, review, and supervise. That's just like a little, you're looking over everything really. Evaluating, reassessing, reviewing, and supervising. And we've only one job left to do then, which is our
Invoice.
it's not the bill. Our completion. And then our completion is to issue the audit report.
That's really confusing.
So like even before you start your audit, you have a lot of work to actually do.
When you've that done, then if you're doing it continuously, you have to review, like what you've done, say, over previous ones to see if you've been doing better, how much you've done wrong.
Yeah, because like the first year will always be the hardest year to do it. Once you're the first in, like it becomes a lot easier.
So
after
say if
that.
you're doing the second or third year, do you look back what you did the first year to see if you could do something better?
Yeah, and see what it can you go back and look at what controls they have and have they improved them, and see what standard testing you did and see can you improve that as well. It can be very like time consuming. Just see. Tonight is the 12th, isn't it?
Yeah.
And if you look at your notes I gave you now again, just on page 4, 5 and 6 of the very first one, the ISA 200, that's the same thing on 4, 5 and 6. But I just think that when you look at it like that, that just makes it a little bit easier to see exactly what you actually have to do. Okay, so it's like accepting, the planning, execution, and the last one, audit completion. Okay, they go into more over here now, but worry about issuing your audit report at the end. For the moment, all we're going to be worrying about. Okay, and see, it gives you all the little different ISAs that actually apply down to it.
Do you need through all of them or just?
No, you won't need to know, but you just have to know certain ones. You know, certain ones from the planning, certain ones from the execution part of it. You're not really, and you can because to know them all off. No.
All the ISAs, is it?
Yeah, all these ISAs. And I gave you a sheet already with all those ISAs on them.
The main ones.
The main one. Yeah, well, it has all of them.
But is there like the main ones that we need to remember? Like
Yeah.
the ISAs?
Yeah, for the like ISA 300 is for planning. Do I give you another sheet there, another line that had like this. Okay, so you have underneath each one what's actually in it. So like the planning ISA 300 for your planning and audit, ISA 320 for audit materiality, 230 for documentation, 220 for quality control. Just like they're under little different headings like that.
And they did the main ones we have to remember.
Yeah, just remember, I mean, not to know them off because it actually mention it in the question. You won't actually have to know them off. ISA this is this and ISA this is this. You actually, it's better to know what they're about than knowing them off.
But you don't have to actually remember that ISA 300 is the planning audit.
No.
Because it
Yeah, it's like all you can do at work, like just go and look it up.
Yeah.
You know what I mean? You can't, but just
it's more practical, like
Yeah.
the building measures.
Yeah,
You need to know that they're there, where to go to get.
yeah, and the understanding behind them then, how you'd actually use
Just
it.
have knowledge of what it actually does, but you don't know the number of it.
Yeah,
No, it's there.
yeah, that's it. Okay, so that's our actual audit process. So I actually got another one then for, just to know, we talk about audit evidence along the way, okay? And we must have sufficient, appropriate audit evidence. And I got another little flow chart we could actually use for that as well. It's just like to help, hopefully, with it. But I always think the open charts and stuff are actually easier than actually reading through a load of different pages. So this is about audit evidence. So you start with your audit evidence assigned to the middle of the page. Okay, so your audit evidence. Okay, so you need sufficient and appropriate. Audit evidence. What you do is like actually bring like a little arrow over, so you've got your audit evidence must be appropriate and it must be sufficient across from it. Okay, and what do we mean by sufficient? Okay, sufficient is the quantity we're actually going to have together. Okay, the quantity of audit evidence we're actually going to have together for our audit. Okay, and our quantity will depend on our risk profile. So just keep our audit evidence separate here as I do. it must be appropriate. Sufficient is the quantity of audit evidence we're going to have to gather, and it depends on our risk profile. So if you've got a high risk profile, high risk, you think you'll gather more or less? More, okay? It means gathering more audit evidence. Okay, so that's what we're talking about in sufficient. The quantity we have to gather, we look at the risk profile, we look at the high risk, and if it's high risk, we should gather more audit evidence. So these are actually all linking down with little arrows down now, just I can't draw an arrow on the computer. I know you can, but I can't. Here. And then we need to have appropriate. Okay, so this is what you're always getting. You're getting sufficient, appropriate audit evidence to back up all your findings for your audit. So your appropriate then actually falls into two categories. It must be relevant and it must be reliable. Okay, so relevant. And reliable. Okay, so our appropriate falls into two categories, relevant and reliable. Okay, so if we look at reliable first, and we're looking at reliable, we're looking at the source of the audit evidence. Okay, so our source of audit evidence.
It's reliable, is it?
Under reliable, yeah. Have I over far enough for it? Yeah.
That's fine.
Okay, and when we're looking at our source of audit evidence, we've got oral, documented, okay, so our source oral, documented, and we're looking at oral, okay, we're looking at asking the directors a question. Okay, so our oral is asking the directors a question. So if you were inside, right, and you were doing your audit, okay, and you saw your rent inside your expenses inside your P&L account was gone from 10,000 up to 40,000 from the year before, okay, you'd have to find out, have to get audit evidence to find out why that was gone up by 30,000 from the year before. So you could do it orally, you could go to the director and ask him why is it gone up, and he'd say it's because there was a rent review and they reviewed it upwards, so you're paying extra rent every month from February, or however much every month, and you say grand.
And you just make a note and say that having spoken to X,
Yeah.
said.
Yeah, that's it. But is that reliable?
No.
So you'd actually have to go further and get a documented version of it. And what you look for is
Proof from landlord.
proof from the landlord to go and look at your rental agreement. So just like to make it easier now, to like we think about you doing your audit, what you do. So you'd ask the director first, he'd tell you something, but then that's not a reliable source of audit evidence. You'd go in and look at get your documentation behind it. So if we were documenting that then, if you want to put an example underneath it, we would go and get the rental agreement, and that'd show the upward rental review. And that's a good source of audit evidence then, because it's documented, it's coming from the landlord, so it's coming from the landlord, it's coming from a third party.
So, source of audit evidence, you put or ask the directors a question and document it and just get proof of the oral answer.
Get proof, yeah, so proof. So we put on here, and that can be vouched, you know, letters, invoices, do you know what I mean? Anything that's actually documented is actually better audit evidence. And what's even better is if you can get third-party confirmation. Okay, and the rent is a good one because, like, do you know what I mean? You can go to the landlord. Another one would be you'd ask you'd ask the director, is there any litigation taking place against the company? And he'd go, no, there's nothing happening. But you'd actually get a third party. Yeah, you go to the solicitor and ask the solicitor for a letter confirming that there's no litigation taking place. And the same with the insurance. You say, is this insured under the company name, the van, or the building, or whatever? And he'd say, yeah, it is. You go get your insurance policy, so now you have a documented evidence and it's a reliable third-party source. Okay, so that's the kind of way we're thinking about just doing it. I think with the flow chart it helps by a little bit. Yeah? Okay, so that's our reliable. Okay, so relevant. You will see now, is your audit evidence relevant? And what we're looking at here are our financial statements. Assertions. Okay, our financial statement assertions. And that is our complete. This one over here. This one here. These assertions. Existence, rights, obligations, occurrence, completeness, valuation, measurement, presentation, and disclosure. So these assertions are what the directors have done with the accounts, and it's like, say you have cash in the bank, right? So say you've got €1 million cash in the bank, okay? They have given you the assertion that it's there, existence, that it's complete, okay? So now you're going to have to actually find all the evidence to show that there's the existence of that €1 million inside in the bank. So what you do, you go to the bank rec first, but the bank rec is what the directors or whoever have made the accounts, but we could actually go a step further and get a third party one by getting a bank letter from the bank. Okay? Yeah? And we'll do more of these assertions as we go on. Okay. Okay, and you want to download the bank one there? So then, say you've got cash in bank, we'll say it was $1 million. Okay, and we've got to prove the existence and the rights to it, I suppose, as well, wouldn't we? That it actually has that money, or measurement, even. Okay, because they can say there's $1 million inside in the bank, but they might have forgotten to actually maybe put in a few lodgements, or, do you know what I mean, they might have forgotten about checks that had been cashed. Their bank record might actually be wrong. So if you get the bank letter then, you're getting the proof. So we're going to request a bank letter. And if we look at our payables, we can see are they complete? Or we would go, go for receivables. No, payables, yeah. And where would our third party be coming from our payables?
Letters from.
Yeah, letters from, and looking at our supplier statements. Okay, so we'd be testing a sample of the supplier statements. Okay, and what we're looking to see, are they understated or overstated? they're understated, it's affecting the company because their profit would be too high, and overstated, their profit would be too low. That's our audit evidence. So, and if you look at, I think just to look at it, you have your audit evidence. Where am I going? Here, audit evidence. Inside the middle. Okay, and coming off it is your sufficient, appropriate, and then your appropriate brought into relevant and reliable. Okay, and as we're going through the exam papers, that might actually help. Do you know what I mean? Thinking about the audit evidence we're actually collecting, as like the oral one and the documented one, especially. Do you know, making sure that it's relevant and reliable. Is that alright? Yeah? And I have another one. I was very busy at the weekend. I just tried to keep up. When I was doing audio myself, I actually found it very hard to actually, you know, think of it as a real life thing. And do you know what I mean? We're getting all different figures from, and do you know what I mean? You can read and read and read and still not get it. But if you have these little tools, hopefully that will actually just help when we go to exam papers and looking at them. So this is just what this is called now is the theory of audit evidence. And it's when we're doing our audit tests.
There's a diagram now again.
It's a little diagram down again, yeah. And it's actually going down this time. It's like a little anagram. It's A, E, I, O, U. Okay, you remember A, I, O, U?
English lesson as well.
Yeah. So it's like what audit test you perform, okay, for little things. So we have analytical procedures, okay, and analytical procedures are part of our substantive testing.
That's under analytical procedures.
Yeah, it's
Or is
part. Yeah, underneath it. Yeah, part of our substantive testing. So it's like each little A, I, U, I have a word. So I take A's analytical procedures. Okay, and then underneath this is an explanation of what you actually use it for. So use analytical procedures in your substantive testing, and what you'll be looking at would be trends, ratios. What's it called? Comparing last year's. Figures to this year's figures. Like if you were never doing an audit, you'd always compare your last year's figures to this year's figures. Okay, our next one then is inquiry. Okay, so E is for our inquiry, and this is an internal one. And it's like our oral, we're asking people. Okay, so internal oral, asking people information and why costs went up, etc. And once done our oral inquiry, we didn't look for our written inquiry. And that would be like our bank letter, receivable circular, stuff like that. Okay, so inside your inquiry you actually have two little things. Your internal, so when you go to, you actually, like, you go out to the business where the audit is going to be, and you'll be inquiring off people, little bits and pieces, and then you'll actually get a written inquiry then after your bank letter or receivables, because that's your proof, yeah. And a better source of audit evidence. Okay, our next one then, I, is for inspection. And this is physically, physical, I suppose, physical would actually be, or physically verified, or physical
Physical verification.
verification, yeah. What have I done wrong?
Right.
Physically.
Yeah.
And that would be like your non-current asset. Okay, so you'd actually go out and look and see is that non-current asset there. That'd be something you think about. Or your inventory, you go and look at the inventory. I'm actually watching one of those videos that's set up for doing an audit of inventory, and the guy went in to count all the paper in a room. Okay, so there was 100 boxes of printing paper. Okay, so he said, yeah, grand, that's fine. That's grand, you have 100 boxes there, there's 6 there's 5 in each box. Okay, but that's wrong. You should actually look at the 100 boxes and pick, say, 5 boxes or 6 boxes here and there, take them down and actually see is there actually 5 in every box. Do you know what I mean? So, do you know, that's like something you'd actually verify then. You'd inspect it and you'd verify that it's actually there, and it actually is 5 greens inside in every box. And of course, in the one I was watching, they weren't full, there was ones empty and all this.
Non-current asset, that's the correct term now, is it, as fixed asset?
Yeah, non-current asset. Yeah. And that's coming in now from the 1st January this year. Sorry, 15. We have to have the change over to this.
That's the American way.
And our inventory.
In practice, you have to do that, is it?
Yeah, at the moment, we're still calling them fixed assets in stock. But I think I was actually looking at it. I said, my boss looking at it today to see do we actually have to change over. I don't think it's compulsory if it's smaller companies and stuff, but it is. But actual companies that are on the stock exchange are already using this lingo. But
isn't it easier for you if you're changing it all to change completely?
Change completely. The whole one. Yeah. But then, like, all the software packages haven't updated yet.
No.
Like we're using Sage now at the moment, and you're probably using Sage, and that still has the old fixed assets and stock.
We've this year's Sage.
Yeah, the new one.
Newest one,
Yeah,
the newest
and
one.
it's still got the old.
Stock,
Yeah.
fixed assets.
Yeah, debtors, creditors instead of receivables and payables. Yeah. But it's supposed to be from the 1st of January. It's a big thing, FRS 102. Yeah. Okay, so that's our inspection. Our next one is observation. Okay, and this is for our test of controls. Controls to observe what actually happening. what I think about there is the inventory in the warehouse. And what controls are in there for actually, taking the inventory out of the warehouse. So really you could actually go into the warehouse and see when someone comes in to get the inventory, are they actually signing for it and is someone actually authorising it? That sees your control actually working. Does that make sense, yeah? Mm-hmm. And then our last one, it's not it's recalculation.
It's stretching it a little bit.
Okay, so we're highlighting the U. T-U-L-A-T anyway. So recalculation. So we're actually recalculating figures. And we can actually recalculate figures inside in our wages. We could do our depreciation charge, see has it actually been calculated correctly. It's like you have notes to the account where they say they use a depreciation charge of 20%. So you could go back into your depreciation in your account and see has it actually been calculated at 20%. Okay, so that might help. Do you know what I mean? You're thinking about what you actually have to do down along your A-E-I-O-U.
A-E-I-O-R.
Yeah, A-E-I-O-U-R should be.
You remember that?
The U. In the one you remember. Calculation.
You remember,
yeah. It's like doing what comes up in the exam is like give the order procedures you would actually use for this. So if you have these, anything procedures, your existence, your observation, your inspection, your recalculation, it's something you could actually think about then to actually give as an example. Yeah. Yeah,
yeah, brilliant. Well, Girls PC.
I've gone to Girls PC this year.
Oh, is it girls now?
Yeah. Yeah, because JLS is no longer there, so I can't use that. It was for our debits and credits. For our debits I use P's, and for our credits I use Girls PC. So debit is purchase expense assets and sales returns. Girls PC is gains, income, liabilities.
Sorry.
What's it?
Receivables.
PC, purchase returns and capital. So like you think then on your debits and
What was
credits.
the R?
Hmm?
What was the R? Or did you skip it?
Maybe I skipped it. Girls PC.
Gains, liabilities, sales.
Yeah, I must have skipped the R. I just had to make up something. And it's just like to help people remember, your debits and credits.
I know
So
myself, even for example, I try to put some straight words in my own head, just
Yeah.
remember
I think if you want to increase your P's, your purchase expense assets, you debit it. If you want to increase your girls' PCs, you credit it. It's always something to try and help people. Okay, and then I have one more little thing just to put up here. And this is about if you were testing a control or if you're doing substantive testing, what's the actual difference? Excuse me. Okay, so this is our test of control versus our substantive procedures. control or we're doing substantive testing. Okay, and say we're looking at payables, okay? So we're looking at our payables. So for our payables here in the middle. And we're looking for the completeness of payables. Okay, so we're looking to see our payables actually complete. Okay, so for testing the control for the completeness of payables, we would inspect. So this is like you have a little arrow now down from test to control. So you have to inspect a sample. SUPP. Sample of supplier statement reconciliations. For evidence that they have been reviewed by an appropriate level of management. Okay, so that's how you're testing your control. You're actually getting a sample of a supplier statement reconciliations for evidence that they have been reviewed by an appropriate level of management. So there should be a signature or initialed at the bottom that they've been reviewed. Okay, whereas for our substantive procedure, then, so a little arrow coming down now to your substantive procedure, you go to inspect your cash book. Okay, your cash payments, or your check journal, I should say, better, wouldn't it? You inspect check payments journal, and verify the payments to the supplier statements. Okay? So here you're testing control, where here you're actually doing a testing scenario. Now you wouldn't test the whole lot of them, you test a sample of them. And you're not going to take the 10 biggest or the 20 biggest, you're going to take a sample from the biggest ones, the medium-sized ones, and the little ones. You just don't go with all, you don't just take the 20 biggest amounts that are rolled by you take a sample out of each part. So that will help a little bit with your difference between your controls and your testing side of it. Okay, so here you're testing the signature on the statement, whereas here you're actually going to your checks journal and you have your supplier statements and you're testing one after the other, make sure the payments are actually all shown properly and stuff like that. Okay? They're all my flow charts for tonight. But I'm going to try and do more than now, just for every little different tweaks as we go along, just to try and help them. So I'm going to go back and do a small bit of theory there. On this handout, the first handout still, ISA 200 and page 7 of that. And this is ISA 210 and it's all about your audit engagement letter. Okay, and if you look at the very top step, I just wanted to change the Companies Act 1963 to 2013 first, just to bring it up to date. Okay, so what we're actually looking at is actually doing our first step, in our audit process here. Okay, so in our audit process, we have we've accepted the audit, or we're continuing with the audit, and now we're actually going to preparing our engagement letter to send out to the client. The client has to send back to us. So in the ISA 210, the terms of the audit engagement. So the auditor and the client should agree the terms of the engagement. The terms of the engagement should be recorded in writing. The ISA is intended to assist the auditor in the preparation of engagement letters relating to the audit of financial statements and related services. When other services such as tax, accounting or management advisory services are to be provided, separate letters may be appropriate. Okay, so if you're just doing the audit, you have the audit engagement letter, but if you're providing tax stuff as well to them, you have to actually include that inside in different engagement letters as well. In the UK and Ireland, the auditor should ensure that the engagement letter documents and confirm the audit acceptance of the appointment, and includes a summary of the responsibilities of those charged with governance and of the auditor, the scope of the engagement and the form of any report. And I actually have a sample of a newly done up audit engagement letter here now for us in a minute. The form and content of audit engagement letters may vary for each client, but will generally include the reference to the objective of the audit financial statements, management responsibilities for the financial statements, the scope of the audit including reference to applicable legislation, regulations or pronouncements of professional bodies to which the auditor adheres, the form of any report or the communication of results of the engagement. In fact, because of the test nature and other inherent limitation of an audit, together with the inherent limitation of internal controls, there is an unavoidable risk that even some material misstatement may remain undiscovered. So a material misstatement. Unrestricted access to whatever records, documentations and other information requested in connection with the audit. So they're the main things you actually put on them, and you have a little heading for each of those little things.
You're doing a sort of preamble there saying,
yeah, you're covering.
I'm doing all this if
yeah, there's still a risk inside there that there might be a misstatement not found inside there. And if you go over to page 10, okay, and it's actually 1, 2, 3, 4, 5, 6, 7, 8 pages long. I remember we used to want to only be page.
Is that standard now, is that linked as well?
That linked, yeah. Okay, and you actually see you're writing to the directors of the company, and you're putting down for the audit in the 31st December 14 or whatever actual year it is. You've done the responsibilities of the auditors and directors, and sorry, you've just changed the year there now again, in accordance with the Companies Act 1963 to 2013. In page 10 there, just in the middle of it there.
right.
And just read the responsibilities of the directors and the auditors there. As directors of the above company, you are responsible for ensuring that the company maintains proper accounting records and preparing financial statements which give a true and fair view in accordance with generally accepted accounting practices in Ireland, including the accounting standard issued by the Accounting Standards Boards and have been prepared in accordance with the Companies Act 1963 to 2013. You are also responsible for making available to us and will require all the company's accounting records and all other relevant records and related information, including minutes of all management and shareholders' meetings, and such information and explanations as we consider necessary for the performance of our duties as auditors. So it's the director's responsibility to actually do the accounts and make all the information available to the auditor. And then we are registered under whoever you're registered to actually work as an auditor. Okay, they give you the 4 that I think there. That could be.
We have to recreate this letter in the next time.
They could ask you to do, yeah,
The letters.
well, no. Like, what they're looking for is you'd have the headings. Do you know what I mean? Like that one now is the important one, the responsibilities of directors and auditors, that they are responsible for ensuring the company maintains the accounts and making all documentation. You couldn't be expected to do it. Let's treat them back. It's knowing what should be actually inside in the engagement letter, and that things like that it's actually made out to the director to the company. and like put in that like under the Companies Act 1963 to 13, just that's for, across the board as your accounts are made are prepared under the Companies Act 1963 to 2013.
You can mention that in anything you're doing, you can mention that.
Yeah, 1963 to 2000. That covers you all then. And so that's the director's responsibilities. But if you look under option 2, second bullet point, it's what the auditor's responsibility is. We have a statutory responsibility to report to members whether, in our opinion, the financial statements give a true and fair view and whether they've been properly prepared in accordance with the Companies Act 1963 to 13. In arriving at our opinion, we are required to consider the following matters and report on: whether property accounting records have been kept by the company, whether the company's balance sheets and profit and loss accounts are in agreement with the accounting records and returns, and whether we have obtained all the information and explanations which we consider necessary for the purposes of our audit, and whether the information given in the director's report is consistent with the financial statements, and whether there existed at the balance sheet date a financial situation which under section 401 of the Companies Act 1983 required the convening of an extraordinary general meeting. And what usually would require an extraordinary meeting if you've made a huge loss, then you actually have to go and do an extraordinary general meeting and say, yeah, and what they usually say is we directors say we're going to make a profit in the coming year and we can still continue to trade. Mm-hmm. But if you make a loss again the next year, like the business is becoming more insolvent, so there'll be more and more meetings having to be held. And you actually have to know 1, 2, 3 those 5 bullet points, because they actually ask what is the auditor's responsibilities. So proper accounting records have been kept. And see, they have responsibility to report to members whether, in our opinion, financial statements give a true and fair view. Okay, so you have to mention true and fair view if you're asked that. And they've been properly prepared in accordance with the Companies Act 1963 to 13. So all that paragraph there and those 5 bullet points after are important if you were to draft an engagement letter. And after a while, this has become, this is actually, when we're doing our audit report, or our very last audit report, and we're wishing our opinion, then all these little bullet points are mentioned in our audit report. So they'll be used, there'll be 2 questions, I mean, that will cover the engagement letter, what the auditor has to do, and to be covered for your audit report as well.
So like in the report we say we believe that proper accounting records have been kept by the company.
Yeah, that's part of it, yeah. And you have them in black headings then that's what you're reporting on. And as then you do the audit report, you'll actually see them on the audit report too. Okay, then our next one is the scope of the audit. Look at the black on page 11, scope of the audit. Our audit will comprise of a statutory audit and to be conducted in accordance with the ISA, okay, UK and Ireland, issued by the Auditing Practices Board. And will include just test transactions and of the existence, ownership, valuation and liabilities as we consider necessary. Okay, so that's our scope of the audit. And it's just so many, I'm not going to read down through all that now, but somebody just read down through and just have an idea of what the scope of the audit is. Then we've got detection of fraud, error and non-compliance with laws and regulations. So this one is responsibility for the company's compliance with company law and other laws and regulation resets with you. And that's important, it's director's responsibility, okay, for company law and other laws. Like laws will include like under the Health and Safety Act, or you have to mention that would be under your laws, that the directors must be, keeping in with or what's the word? Adhering to the Health and Safety Act, to ensure that the company complies with the requirements of the Companies Act 1963 to, just change that to 2013 again. And you are also responsible for safeguarding the assets of the company and for the prevention and detection of fraud and error. And then, however, we shall endeavour to plan our audits that we have a reasonable expectation of detecting material misstatements in the financial statements or books of account, although our examination should not be relied upon to disclose all such material misstatements or fraud, error or instances of non-compliance as may exist. Okay, so that's important that the directors are responsible for the laws and that the auditor is not responsible for finding the fraud, but they may in the course of their audit discover fraud has been found during the audit. Then the accounting services, company secretarial. We have made that we shall, as our agent, prepare the financial statements based on the accounting records maintained by yourselves on the basis that you will make full disclosure to us of all relevant information. In providing the agreed services for you, our agent will be that professional person and client, save when we are instructed to negotiate tax liabilities with the revenue commissioners. We have also agreed to provide assistance to the company secretary for preparing and lodging returns to the register of companies and to deal with any routine secretarial matters that may arise. So you have to return what's called a B1 to the company's registration office every year. Every company has to do that, whether they're trading or not. They still have to return a B1. And to allow us to carry out these services, all books, record and explanations requested by us must be submitted on a timely basis to allow us to assist you in preparing returns for the register of companies, and that the directors of the company have taken steps to ensure that the audited accounts will be available to be annexed by the relevant returns. So you've got a CRO date. So say your year end is December, you might have a CRO date 6 months after that, or 9 months after that, when your accounts have to be into the company's registration office. And then, for tax, they must actually be in 9 months after the accounts year end. And the directors of the company are primarily responsible to that the company's, the provisions of the Companies Act again, 1963 to 2013, and will, if necessary, seek proper legal advice and record all decisions of the directors and members in minute books maintained for that purpose. And then tax compliance services, so you actually have to mention all the tax you're actually doing. So if you're doing their corporation tax, you're doing their PYPRSI, doing their VAT, doing capital gains for them maybe, all the taxes, RCT returns, you'd have to mention each one separately that you're doing them, and that has to be included in the engagement letters. Under each individual thing, and what exactly you're doing, and whether you're making returns to the revenue for them or they're making the returns themselves, but it all has to be documented inside in the engagement letter. And then this is the next one in, this can be tailored to every client. I mean, company law has to go into everyone because you have to adhere to the company law.
In the engagement letter, they're saying if you're making the returns for them, but does the auditor do that?
For a big company, it wouldn't.
Or is it like you were saying, if it's a small company, you'd be auditing and doing the accounts as well?
Yeah.
And that's the engagement letter for that?
Yeah, and this is actually a large one. Yeah, this is actually a print office for a large company. But if you do a small company, you have a certain line in there.
You're doing the accounts as well?
Accounts as well, yeah. And when you're doing your notes at the end, you have your notes of the accounts at the end of the year, you have to put in that there's a certain thing, I think it's the 1983 Companies Act, that you're entitled to do their accounts as well as do their tax as well as do the audit. Because you can't, for a small company, you couldn't be asking to go. You have no clients left. We told them you couldn't do the audit, you couldn't do the accounts, they'd say, well, we'll go to someone who actually will do the accounts and will do the audit. But so many small companies now are audit exempt that, you've no problem. But you still have to have the letter of engagement inside there. And you have an audit, instead of an audit letter of engagement, you have an audit exempt letter of engagement. So you still have all that stuff in there. It's just, they're exempt. Yeah, makes life a lot easier. Okay, then we've got criminal law, then we've got anti-money laundering. That's a big thing at the moment in the real world, anti-money laundering. Additional legal responsibilities regarding taxation, reporting third party. Yeah, that's another part, reporting third party. And we have electronic communications, because everything is done, everything to the CRO now and to the revenue is done online. Fees then, you mentioned what your fees are going to be for the whole audit. Confidential information, in applicable law, agreement of terms, then the auditor signs it and then you get it signed by 2 directors at the end as well. And we'll see when we're doing exam questions how they actually will ask it. Yeah, but I know it's like a bit, there's a lot to actually remember inside it, but if you can remember the main headings and what should be inside it, like the responsibilities of the director and the auditor is the important thing. Then about the detection of the fraud, the scope of your audit, tax compliance, company secretarial, criminal law, company law, all that stuff. You can remember the headings at least for the moment. Well, in the exams we go deeper into them, we're seeing exam questions. I'll plug out an exam question for it.
And normally would an accountant or an auditor have to give that to their solicitor to see if it was alright before you give it to your client?
Oh
Or
no, you
one?
just do it, yeah. You just have one on the computer and just change the
And
name.
they're always the same.
And they're always the same. Yeah. Keep it our way. Oh, it's 8:05 already. Jeez. So I took a break there maybe for 5 minutes just to get the heads, because